Good evening. Welcome to another edition of the ShadowTrader Video Weekly for Sunday, March 1st, 2020. My name is Peter Resnicek from ShadowTrader.net. What a week it was. Huge volatility in the markets, taking out the entire rally from October 3rd, 2019 in one fell swoop. Those of you that have been paying close attention to these videos, you'll know that I talked very often about the poor structure that was beneath us and that someday, somehow, it would all get repaired. And when it did, it would happen very, very quickly. All of that stuff is all gone. I'll touch upon that, of course, in the market profile section of the video. But first, I'm going to talk a lot about technicals. I'm going to talk specifically about something that I call the buyer's shut-off pattern. This is something actually that I use in day trading, but I feel like it bears mention in this market because I think it's applicable to longer-term charts as well. That's actually the pattern that the market is exhibiting right now. It's something that I call buyer's shut-off. So we'll take a close look at that. Volatility, we'll definitely touch upon it. The time to talk about volatility is essentially when it exists. We've been used to vol at a 11 to 13 handle in the VIX for a very, very long time now. This week it went to 50. So we'll take a close look at that chart and see if vol could actually push higher or not. Lots of emails as of late on crude oil and gold because crude oil has been selling off very heavily with the markets. Gold actually rallied opposite the market, which is what I would expect as far as being a haven on news of a potential pandemic. But on Friday, it actually got sold off quite hard. The GLD was down $5, which is really a lot, about $50 an ounce in the metal. So I'll look at that chart as well and show you where I feel support is coming in for gold, all right? Last but not least, I'm going to turn the camera back over here after I finish the analysis portion of the video. And for what it's worth, I'm going to give you my opinion on what I think is going to happen in the next couple of weeks. All right, without further ado, let's get into it. So I'm going to start with a quick look at monthly charts. It really doesn't make sense to look at monthly charts at any other time other than on the last day of the month. And being that I'm recording this on the last day of February, today is a day when it makes sense to look at the monthly. So obviously the range is huge. The candle is really long. I don't know if it's the largest on record or whatever, but you can just quickly glance at it. Going backwards, you can clearly see we haven't had this much range expansion. Even here, I think it seems like it's smaller. I haven't measured them, but just kind of eyeballing it, it was obviously a huge range. I mean, we made a new all-time high in the month, and then we took out a number of bars before it. And that's really the reason why this video is called Buyer's Shut Off, because this is the essence of the Buyer's Shut Off pattern. I've got some Fibonacci on here, which we're going to need for a little bit later, so I'll just switch this to NDX, which doesn't have it. And Buyer's Shut Off is basically whenever you have any situation where two or more bars, preferably like three, get negated by just one red bar where the range is. Now this NDX is kind of probably not the best example. We'll look at the rut instead because it's a cleaner bar. Where you have the entire body of the wide range bar, of the red bar, taking out, just the body takes out the entire range of the prior bars, including the shadows. So that's what I call buyer's shut off. And this is a pattern that I came up with mainly for day trading, but it's also applicable to longer term technical analysis like this. The way that I use it in day trading is very simple, is if you have your 3 or 4 up bars and then the one big red bar negates them all, what happens is it's not a short right away, but you target this bottom here on any bounces. So you look at it like you start to put sell orders up at like halfway mark or wherever, and the market just kind of slams into those and comes back down and retests, and usually will go even lower. So it's a very bearish setup when you have buyer's shut off, whenever you have this big bar taking out multiple bars that went up prior. So that's important to know. Now, if we look a little bit more granular here on the dailies, and we'll go back to the SPX, and this is where the fibs come in. This is what I really want to focus on. You notice that the entire rally from the October 3rd low, this is October 3rd, 2019, has now been negated, okay? It took out all of it, and while it was taking it out over the course of late last week and into this week, I had the Fibonacci retracement levels of 50 and 61.8 on it here to see if we would get any sort of a bounce at those levels or if we were going to go through. Closing below a 61.8% retracement generally increases the odds that you will have 100% retracement, and in this particular case, that is exactly what happened. And notice that the bounce was exactly pretty much right to the penny on the 100% retracement. This is very common in that usually when you retrace 100% of a move, the zero line, if you like to call it, you can call it the starting point of the move. When you go up and you come back to the starting point of the move, it's very hard for markets to break through the starting point of the move right away, especially when they're coming down from the top, as I call it. That means simply that when they've already traveled very far, they will almost always have a bounce at that level. Similar to the buyer's shut-off pattern in day trading. You don't short that low. You actually either buy that low or you look for bounces off that low and you short a little bit higher, expecting that low to get retested. So I do expect this low to get retested as well in the future, but we'll obviously take it as it comes day by day. Now, if we look at the same analysis on the NDX, this is kind of interesting because it's actually a slightly different pattern in that it didn't really retrace as much. If we look at the same October 3rd low as our starting point, we take the fibs up to that all-time high, you'll note that we did take out the 50%, and we did take out the 628. We actually opened below the 628 on Friday, but with this rally, we actually found support at the 200 period moving average on the daily, and more importantly, there's an immense amount of space here between the low of Friday and the October 3rd low, so that is noteworthy. And then if we look at the Russell actually was the weakest of all of them, I think, because it closed the lowest. You can see here that here is the October 3rd low, correct? And notice that the RUT actually traded through it and closed without the type of bounce that you're seeing in the SPX. Actually closed relatively weak and closed very, very close to it. Okay, so that's the Russell. This is a typical risk-off measure, I would say. Basically, small cap stocks a little bit riskier, not as much multinational presence, could be more speculative, more experimental. That's the RUT, small caps. And so usually strong selling in the Russell is indicative of a risk-off environment. So we will keep that in mind. If we see the Russell start to outperform, then it's more of a risk-on environment. Okay, so that basically is, or are, I should say, all the technicals that you really need to know as far as S&P 500, NASDAQ, and Russell. All right, let's move on into volatility now. We had a huge move in the VIX this week, almost touching 50. So basically what this means is option premiums have been extremely expanded, just like the insurance that you would pay for a hurricane if you knew the hurricane was right at your door, right? It's the same exact thing. Now, how high can volatility go? This area is actually pretty noteworthy here at 50 because if we go out to longer term charts and we switch it out to the weekly, we should actually look at the monthly so you can really see it clearly. Notice that this 50 level has been resistant in the past. This is actually pretty noteworthy in that if the market was to bottom here, the volatility index, at least for now, is painting the right picture, basically. That if this is going to be a low and that was it, and we have the usual market activity that we've had for the last couple of years, basically, where the market just treats these sell-offs as huge liquidation breaks and then gets bought back up. Certainly the VIX for now is pointing to that, in that the volatility ran to the resistance line at 50 and and backed off. Now I want to point out this area here is where it was a much stronger sell-off in the 08-09 when the market bottomed out in March of 09. Just note that the VIX went all the way up to between 85 and 90. So it is possible. Volatility has been higher in the past and it could move higher. All right, let's take a brief look now at market profile. This is a little bit tricky because I'm turning the mouse wheel here like this, right? Kind of forward, and this is literally as small as I can get it. The ranges have been so large that I can't scrunch the chart enough to actually show you everything that's happened. I can only show it to you in pieces. So let's just start from the top. Obviously, we have the all-time high here. There was an all-time high in an overnight session that's not printed here. Just keep that in mind. These are just things that I like to carry forward. This virgin point of control, I've started numbering them now as 1, 2, 3 above and 1, 2, 3 below. I'll talk about below for a second. This is also a VPOC now, right? So I have to label that one. You can see the little bit of green in here. There's a virgin point of control there. This is also going to be a VPOC now above us. I will eventually take my time and number all these. And here's where the virgin points of control started below us, correct? And notice that this one, which was number 13 from February 4th, didn't get traded through and really has to be kept as a VPOC. I'll renumber it probably as 1 on the upside, 2, 3 now. And this gap, which is huge, this yawning gap from like 33.28 to 32.60, that is still there and also needs to be carried forward. So now it's almost like a flipping effect, sort of mirror image of where we used to have all this structure on the downside. It needed repair, and we repaired it all this week. I'll get to that in a second. Now we have those gaps and virgin points of control above us. Obviously, everything is kind of flipped. So moving down, the main takeaway from all this you want to note is that all of those virgin points of control that I talked about, of which I believe there were 15 or 16. Don't quote me on that. I'm not sure. I don't remember exactly because I started erasing them as we were coming down. It was the highest number I had ever seen. It was so many virgin points of control between the October 3rd low and that February high. All of them have now been taken out. You can see that as I go lower on my chart, everything has been taken out. These VPOCs are now VPOCs sort of that are above us that happened, because of the selling. You can see here the green line is where we are. So I have to actually go through and label all of these now as virgin points of control, and I will do so. For the subscribers of the Peter's Pre-Market Perspective, I will put all that in there. Probably in the Monday edition, I will do a new VPOC list and put the, all the ones above us and list the gaps as well. So moving down, again, everything has been cleaned up, which brings us to Friday. This will now be our point of control from Friday. Notice that it did, let me just label it correctly, POC. Notice that it did migrate down with price. The range was pretty big. It was kind of a sideways day on Friday, although sideways in a very large range, but the range was, it was different from the other days of the week where it was kind of a trending day where you just opened high and like closed much lower. It was more of sideways action on Friday, but within that sideways action, the point of control, which is where the most volume traded at price level, did migrate to the downside. It was relatively low. And looking in here as we make it all the way down to the low, lo and behold, as always, there's the signal that there's a potential low. You have the small number of contracts and also the taper of volume. Taper just simply means that all these contract levels are under 10,000, right? And it just kind of gets smaller and smaller as it goes. And you can see here that it tapers down like that and gets smaller and smaller as it goes. Now, does this mean that that is the low of this move? It does not. The taper signal and the signal of the low contracts at the bottom of a range is a very strong day trading signal only. It just means that the down auction at that moment has ended. It does not mean in any way, shape, or form that the down auction in the bigger picture has ended. Now, could it be? Of course it could be, but I'm telling you that this is not the signal for that. This is a day trading signal when you're trying to buy a low or buy some sort of support level. You have your market profile chart up and you watch those contracts tapering, volume getting lower and lower, and when you see that low number that's lower than 100, it's like a 2-digit number. Very often, when you see that number print and you see the price level go back up and leave that low number on the bottom, more often than not, you can smack it long right there, and you have fantastic trade location. Okay, let's take a quick look now at crude oil and gold. I get a lot of emails on both of these, a little bit more on gold than on crude, but I do get a lot of crude questions via email, and so I thought I'd get into it. Obviously, the hint or scare of a major global slowdown due to the coronavirus fears has pushed crude oil lower. This is a monthly chart showing how it has broken trend now, which is noteworthy because this, I think, was an important trend from the low of 2015. Again, these are monthly bars, so this is a long-term trend. Usually when you break a trend like that, you do what I call filling up the triangle. When you have a trend line, basically this is your triangle, And when you break trend, your target is always to the base of the triangle. So I foresee that crude oil should move a bit lower over time to 42. I think any bounces up into the body of this candle, this monthly, if you can see 47, 48, 49, anything up to about that 49.50-ish area right in here, which is where the trend line is, any of those are probably shorts, and again with a target to about 42 a barrel. When we reach that 42 a barrel, notice that this has been support once, twice, this would be the third time. There is potential that it may break, and you could make the argument that this is the triangle, correct? That this is the short-term triangle, as I just drew here, and it would take it to there, but then you have this longer-term one, and there's potential that crude would go back here, and it would take us to that low, which happened in 2016, which is about 27.56 exactly, 27.56 per barrel, which would be really, really low. That, of course, I think would be a fantastic buying opportunity. Obviously, the world is not going to end, and people are still going to use oil, and that bounce could be very, very lucrative. So if it was to get down there, we shall see. All right, let's take a quick look at gold. Gold got really smacked on Friday, which was actually pretty surprising to me. I had a bullish position on it that I had to scramble a bit to get out of. It was one of the largest weeks from a long time, I would say, in terms of downward move in gold. Kind of a bearish engulfment as well, right? Bearish engulfment is when the new candle, the red one, engulfs, you know, the prior candle is fully inside of it. Took it right to a trend line low. Right now, basically, gold's at support. The question is whether or not it's going to hold. This area here also should be supportive a bit, as there was some value there. We spent a lot of time there. But really, it's all about this trend line in the gold. It's all about this roughly 146.80 area. Give it some leeway, I would say. Call it like 145.50 to 147.50, I would say, is support. If not, then gold could move a bit lower, maybe to this weekly 20 MA. You can look at it on a daily to see exactly what it is. We also got support right at the 50 MA, which is bullish, although gold is not really one to kind of hold the 50 perfectly. If you look at the chart, gold kind of rides the 50. It's not like an individual equity where the 50 MA or a 20 MA for that matter are very often turning points like right on it, right? It's more of a kind of ride along with it. All right. All right, last but not least, it would not be a very good video if we did not look forward rather than just in the rearview mirror. So what to do now? How am I personally going to play this particular market? So the first thing you have to do in figuring out what is the next move is simply flip the Fibonacci's, right? We had it where we were looking at the Fibonacci retracement of the up move. Now we have to start at the top and go downward to the low, right back to the October low, and see where the Fib retracement would be back to the upside. So we know that here, and look at how far the market would have to go, although in this volatility this can happen in a couple of days, just to get halfway back would be up to the 31.25. So keep that in mind. The way I like to think of Fibs is you can think of the 50 as like what it should do. Most markets will retrace half the move, especially when it's a relatively large move, and then roll over. If the market starts to roll over long before that, okay, that is a sign. If we see just sideways action here in the 2,900 to 3,000 level in the SPX, and we don't get any activity, major activity to the upside, that could be a sign of rollover. If we get a fast movement up to the 50, meaning that over the next, say, 2 to 3 sessions, we just go boom, 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 right to it, well, then great. Look at that 50 as a short point. Put on a short. It's probably a very, very good risk-reward type of short. I'd be looking at that, okay? The next level, obviously, is the 61.8. This is the golden ratio. It's the most important one. We could go all the way to the 61.8. The key with the 61.8 is that if there is even just one candle close, just one daily above the 61.8, that it increases the odds that we go to 100. So the market has to not stage a close above that 61.8 in order to remain bearish, okay? So basically, watch your Fibs as the market is moving up. The other key level is more than likely this 200 period moving average. Then also at the same time, continue to do intra-market analysis. I'm going to be looking at everything as I trade next week. I'm going to be watching the Russell, as I said earlier, to see if there are any signs of it strengthening up for a more risk-on environment. If the rut remains weak, that could be a sign that the market is going to remain weak. And the fact that the NDX didn't sell off as much is also interesting to me. Remember, I'm going to be keeping in mind that there's been this relative strength in the NASDAQ stocks, and they've been holding up better than the others, right? So that also could be a signal, meaning that if we see the NASDAQ rally and recover like a huge portion of this, and again, we have to kind of flip our Fibonacci's here. So we'll just, again, start from the top. And what's interesting about this one is we're only going to here, to the 200, right? Because it didn't go down to here. Notice that this is also going to be a tell for the markets, is what happens with the 50 and the 61.8 of the NASDAQ 100, which is showing so much more relative strength. If the NASDAQ 100 was able to stage a confirmed close where you had a daily bar closing above that 61.8, which is easier to do in the NDX than it is in the SPX because it doesn't have to travel as far, that also could be a tell that the market is looking to go back to those all-time highs and is treating this move down as if it was just a liquidation break, even though I think, in my opinion, it was more than a liquidation break. Volume was strong, internals were very, very bearish, and the potential for catalyst is there for a global slowdown, which would kick markets, which would send economies into recession, and that would cause a longer-term bear market. All right, that's all for this week. Thank you, as always, for spending a little bit of your weekend with me. Remember, you can always check out all of our options advisories down here at the link below. All the information is there for you. I hope you can join us. What do I think is going to happen over the next couple of weeks? There are some indications to me in the market that the selling was very emotional, and it came down to a very key level, 100% retracement from the October rally to here, and then bounced a little bit on Friday. That being said, I can't imagine the selling to kick off a potential larger bear move being anything but emotional when you have a catalyst like this. This particular catalyst of a potential slowdown globally because of what may happen mostly in China, but then the contagion, and I mean contagion in the true sense and contagion as people say, and almost in the financial sense as well, that could potentially spread to other economies is real, and it's very, very serious. And if that happens, it will hurt the bottom line of American companies as well, earnings, etc. Everything has this ripple effect. So I do think the potential is there. How to look at it from a technical level, just be as scientific as possible about it. I talked a lot in this video about Fibonacci levels. Okay, halfway back up, 61.8% back up. That's very, very important. All you have to do is just draw those lines on your chart. It's not really difficult. A more bearish market is going to remain below the halfway mark and is going to roll over again and retest that October 3rd low. A stronger market is potentially going to rally all the way up to the 61.8% retracement, right? At some point as well, we can probably draw a downtrend line, right? From the high over to wherever that rally point is, wherever it peaks out. And now we have a downtrend in place. And we know that we just have to remain short underneath that downtrend, or we're going to be initiating longs if we were to break up out of that downtrend. It's very, very difficult to say at this point what exactly is going to happen because there's so much emotion in the market. But we've got these tools at our disposal, so we should use them. We know where the October low is. We know that potentially in this type of volatility environment and the amount of fear that's out there, retesting that October low again early next week or whenever probably breaks it and sends the market lower. I showed you in the charts that there's actually a lot more room technically to move lower, to go down to longer term trend lines, especially in the NASDAQ 100, which has been showing some relative strength, right? Those have been holding up better. They've got further to fall. The Russell also is the wild card. As always, it's very, very weak. It's signaling risk off. So let's see what happens. It closed just above that October low, but up with a very, very weak bounce, and it actually pierced that a little bit during late week action, right, as I showed you on the charts. That's also noteworthy. If you start to see that Russell move below that October 3rd low more definitively, again, more of a risk-off signal. So again, it's hard to say with this much emotion out there. Obviously, the market in this type of analysis is always hard to say, but we have tools at our disposal. So think of all of these things as data points in your narrative and sort of weight them, as you go through and you apply these data points to your trading. That's how I've always approached the markets. I think it's all one big collection of data points, and I'm always very, very careful to do two things. One, not put too much emphasis on any one data point, because it's always the collection of data points together that form the bigger move. And two, not ever to let what's going on in my personal portfolio influence my bias or opinion of what I think the market is going to do. I want to stay as objective as possible and pretend at all times as if I had no position. Obviously, easier said than done, but that essentially is the trick. All right. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I wish you good trading and good night.